Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, March 6th, 2024. I hope you are having a fantastical day out there. It was a beautiful day here in Colorado. The clouds are moving in. Like I said yesterday, we're due for a little more precipitation, some snow and such over the next, I think, tomorrow and Friday. So apologize for being a little late today. I had to go do my mail run to go pick up mail at my office address and do some other errands while I was out. So I apologize for being about a half hour behind. But anyway, so like I said, hope you're having a good day. If it is your first time watching Liberty Call, if you could give me some thumbs up, a like, a share, a subscribe, a follow. Press that notification bell. Looks like the markets were in a better mood today. So let's go ahead and check out and see how the markets did. Dow Jones was up 0.2%, 75 points, closed at 38,661. S&P 500 was up 0.51%, closed at 5104. NASDAQ up 0.58%, closed at 16,031. The VIX was flat. It's currently at 1450. Let's see, Canada up 0.32%, Brazil up 0.62%, and Mexico down 0.35%. Over in Europe, Germany, again, another slow day, only up 0.06%. The UK up 0.43%. France up 0.28%. The Netherlands up 0.69%. What is that? Spain. Yeah, Spain's up 0.79%. Italy up 0.66%. Switzerland up 0.72%. And Portugal up 0.26%. Sometimes I forget which flag is which. Let's see. Russian exchanges were both up again. I think this is the third day in a row. MOEX up 0.31%, RTSI up 0.35%. And the Asian markets, the Nikkei in Japan was up 0.06%, Australia up 0.12%, New Zealand flat at 0. In China, the Shanghai was down 0.26%, the Shenzhen Component down 0.23%, China A50 down 0.76%, TJ Shanghai down 0.16%, Hang Seng up 1.7%, and Taiwan weighted was closed again. All right, so those are the markets for today. I know Powell is having his congressional hearings today, so I'll be curious to see what sort of news or hand wringing comes out of hearing what he had to say. So, all right, let's get to the market recap. S&P 500 ends higher after Powell reinforces rate cut hopes. I'm not sure why he's giving them that sort of feel, but maybe he thinks that the markets are going to tumble here sometime soon and that they'll give him a reason to, a justifiable reason to lower rates, as opposed to people don't like paying mortgages at 6. I mean, sorry, that's just life sometimes. All right, diving in on Wednesday, the S&P 500 rebounded, driven by a resurgence in the tech sector following Federal Reserve Chair Jerome Powell's remarks hinting at future interest rate cuts. Powell's prepared remarks signaled the central bank's intention to lower its benchmark interest rate later in the year, citing confidence in the economy's strength. While Powell's tone was not explicitly dovish, economists interpreted his remarks as supportive of potential rate cuts, with Bank of America Securities anticipating a policy adjustment by June. Market sentiment was also influenced by positive economic data indicating a robust labor market despite fewer than expected private job creations in January. Investors awaited further insights from the upcoming non-farm payrolls report due on Friday. Tech stocks led the market rally, with chip makers like NVIDIA, Intel, and Taiwan Semiconductor Manufacturing witnessing significant gains. JP Morgan's optimistic price target revision for Taiwan Semiconductor further fueled investor confidence in the sector. Meanwhile, cybersecurity firm CrowdStrike reported strong quarterly earnings, driving its stock price up by 11%. Similarly, Box Inc. exceeded Wall Street estimates in its quarterly results, with expectations for further insights into its long-term strategy at an upcoming analyst day. Excuse me. Campbell's Soup also performed well, benefiting from price hikes and reaffirming its full-year guidance, while luxury retailer Nordstrom faced a 16% decline in its stock value after disappointing annual earnings forecasts. In notable news, regional bank NYCB experienced a significant rebound, rising 8% after securing over $1 billion in funding from investor consortium led by Stephen Mnuchin's Liberty Strategic Capital. The funding, facilitated through stock sales and leadership changes, provided a much-needed boost to the struggling bank's financial position. All right. So again, kind of going back to everyone, wondering what the Fed's going to do. I said this probably 5 or 6 times already in the last couple of months, but why are we going to lower rates if everything's fine? I mean, out of one breath, out of the administration and the talking heads on TV is that we have the perfect economy. Everything is fine. You know, I know somebody's trying to get reelected, so of course the government's not going to say anything negative. But it was the same way 4 years ago. You weren't going to get the same honesty out of the Trump administration, and I don't expect it out of Biden's either. But if things are so wonderful, why does the Fed have to lower rates? I mean, again, wouldn't you wait and keep raising rates incrementally at maybe you slow it down, like you could do 0.1% instead of 1/4 or whatever, but keep gradually raising those rates until the economy actually starts to flatline, and then you've reached your neutral rate. And if you need to kick it down a 1/4% or whatever, at that point, that's when you do that. Not now. I mean, today just makes no sense. All right. Next up, U.S. labor market steadily easing as job openings and resignations decline. All right. In January, the U.S. job openings experienced a marginal decline while worker resignations hit a 3-year low, indicating a gradual easing in labor market conditions. The decrease in resignations suggests a potential slowdown in wage inflation and overall price pressures. Despite this, there were still 1.45 job openings for every unemployed person, signaling a strong labor market compared to pre-pandemic levels. Again, see? Financial journalists keep telling us that, everything is fine. Everything is good. Federal Reserve Chair Jerome Powell's remarks during the presentation of the monetary policy report indicated expectations of future interest rate cuts, aligning with the JOLTS report's findings. Economists anticipate a gradual softening in the labor market. I almost said soft landing because they've said it so much. Softening in the labor market, allowing the Fed to delay rate cuts while maintaining economic stability. They've done such a good job so far. Job openings slipped to 8.863 million, slightly below economists' forecast, with notable declines in government sectors. Well, that's a good sign. Private educational services and retail sectors also reported decreases in unfilled positions. However, hiring dropped to 5.687 million, with declines in various industries, including transportation and healthcare. Worker resignations decreased to 3.385 million, the lowest since January of 21, potentially contributing to cooling wage growth and inflation. Despite this, job cuts remained low, indicating overall stability in the labor market. The ADP National Employment Report showed a decrease in wages for workers remaining in their jobs, reflecting broader trends of wage moderation. Additionally, the quits rate declined to 2.1%, suggesting reduced labor market confidence. Looking ahead, economists expect non-farm payrolls to increase by 200,000 jobs in February, maintaining a strong pace of jobs growth compared to the needs of the working age population. While the unemployment rate is forecast to remain unchanged at 3.7%, annual wage growth is expected to slow to 4.4%. Overall, the data suggests a rebalancing in labor market supply and demand, providing insights into the ongoing evolution of the U.S. economy. So it appears that the jobs numbers, again, look okay, but keep in mind, those are lagging indicators. You don't fire people when things just start to get bad. You'll wait till the last minute to you may get rid of the trash that, you need a reason to get rid of them. And you're like, all right, get rid of it. You're out of here. You don't show up for work on time. You do a terrible job. Bye-bye. So anyways. All right. Last up, some more good news. This comes from Zero Hedge. It's titled Doomsday Clock Ticking. U.S. Unfunded Social Security and Medicare liabilities hits $175.3 trillion. This comes from Adam Andrewski of openthebooks.com. That's a tough name, Andrew, or Adam. I'm sorry. Let's see here. The financial report of the United States government for February 2024, signed by Treasury Secretary Janet Yellen, reveals a staggering estimate. Social Security and Medicare face a combined underfunding of $175.3 trillion. Add that to the $34 trillion in debt. This immense figure exceeding the gross domestic product of the entire world and nearly equivalent to the total federal spending since the Constitution's inception in 1787 underscores a dire financial crisis. Medicare is projected to cut benefits within 7 years, while Social Security's trust funds are forecasted to run dry within a decade. Well, those trust funds are just IOUs because they took all the dollars out and replaced it with like T-bills and bonds and notes and all that good stuff. So there's no money in there. I mean, not that the dollar is real money anyways, but you can trade it for gold and things like that. with complete depletion expected by 2041. The situation has worsened dramatically over the past decade, with unfunded liabilities swelling nearly $50 trillion or 39% since 2013. The Treasury's 75-year projection paints a bleak picture, indicating $78.3 trillion funding gap between projected payouts and revenue. The shortfall can only be addressed through increased borrowing, higher taxes, reduced benefits, and or a combination thereof, all politically contentious options. Yeah, no one wants to lose their easy job in government because they have to be honest with people. It's just easier to keep printing money. Furthermore, the infinite horizon model reveals even deeper funding gaps, highlighting the unsustainable nature of the current system. Current participants are projected to use $105.4 trillion for more from Medicare and Social Security than they contribute, while future participants face a $69.9 trillion deficit. Key breakdowns of unfunded liabilities include Medicare Part B accounting for $99.5 trillion and Social Security needing an additional $68.8 trillion. While these programs were intended to be self-sustaining, they now face a looming crisis exacerbated by demographic shifts and rising healthcare costs. I think that's why a lot of people want to bring in all the illegals, is that, they, add to the tax base, and a lot of times they're not, because they're not legally here, they have a fake Social Security number and they're contributing into the system, but they'll never be able to get that money back. Not that I think I'm going to get the money back, because I think they're going to waste it before I ever get old enough to see it. Historical bipartisan efforts, such as the Social Security Reform Act of 1983, provided a roadmap for potential reforms. However, leadership and political will to address the crisis have been lacking, leading to continued fiscal deterioration. Reasonable bipartisan reforms, such as addressing mistaken payment and fixing immigration, offer potential solutions to mitigate the crisis and ensure the sustainability of these vital programs for future generations. I say just blow up the federal government and handle everything at the state level. Personally, I don't want or need Social Security or Medicare. I'd rather just deal with it myself. I don't care to be a burden on my neighbor or my friends and family. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.